Hello and welcome to the IFRS 17 training series. In this video, we will cover IFRS 17 basic concepts. First, we'll start off with an overview of IFRS 17. The effective date for IFRS 17 was January 1st, 2023, with parallel reporting for January 1st, 2022 to December 31st, 2022. And IFRS 17 replaces the existing IFRS 4 accounting standard. IFRS 17 establishes principles for the recognition, measurement, presentation, and disclosure of insurance contracts within the scope of the standard. And we will define what contracts are in scope of the standard later in this video. IFRS 17 applies to insurance contracts, including reinsurance contracts that an entity issues, such as from reinsurers, reinsurance contracts an entity holds, which are called reinsurance contracts held, and investment contracts with discretionary participating features the entity issues, provided the entity also issues insurance contracts. IFRS 17 does not apply to warranties provided by a manufacturer, dealer, or retailer in connection with the sale of its goods and services to a customer. It doesn't apply to employees' assets and liabilities from employee benefit plans and retirement benefit obligations provided by a defined benefit retirement plan. It doesn't apply to contractual rights or contractual obligations contingent on the future use of or the right to use a non-financial item, for example, license fees or royalties. It does not apply to residual value guarantees provided by a manufacturer, a dealer, or a retailer, and to a leasee's residual value guarantee when they are embedded in a lease. It doesn't apply to financial guarantee contracts unless the issuer has previously asserted explicitly that it regards such contracts as insurance contracts and has used accounting applicable to insurance contracts for those financial guarantees. And it doesn't apply to contingent consideration payable or receivable in a business combination. Finally, IFRS 17 does not apply to insurance contracts in which the entity is the policyholder. So here we're talking about self-insurance, unless those contracts are reinsurance contracts held. So what is an insurance contract under IFRS 17? Well, the definition is a contract under which one party, the issuer, accepts significant insurance risk from another party, the policyholder, by agreeing to compensate the policyholder if a specified uncertain future event known as the insured event, adversely affects the policyholder. So for it to be an insurance contract, you need two parties. One, the issuer, or typically the insurer, and two, the policyholder. And you also need some sort of insured event that if it occurs, it would adversely affect the policyholder. And if it does occur, the insurer would compensate that policyholder for that loss. So what is insurance risk? Well, it's a risk other than financial risk that's transferred from the holder of a contract to the issuer. And it's key because we need to have significant insurance risk in that contract to make it an insurance contract. IFRS 17 also requires us to separate the components of a contract and value them according to the applicable IFRS 17 standard. And the pie chart here shows several different components that might be found in some insurance products that are typically sold by insurers. The green pie, or the green piece of the pie, represents insurance components, non-distinct embedded derivatives, and non-distinct service components. And these three components are subject to IFRS 17 with no modification. The light blue piece of the pie is the non-distinct investment components, and these are subject to IFRS 17, but they are excluded from insurance revenue and insurance service expenses. The yellow piece of the pie represents distinct investment components, and these are not subject to IFRS 17 and instead are subject to IFRS 9. The dark green piece of the pie represents distinct embedded derivatives, and these are not subject to IFRS 17, but subject to IFRS 9. And finally, the dark blue piece of the pie represents distinct service components, and these again are not subject to IFRS 17, but they are subject to IFRS 15. So whether IFRS 17 applies or not would depend on whether the component is distinct or non-distinct. An assessment has to be made for each component of the contract to determine whether that component is non-distinct or distinct. And we'll go over this in other videos in our IFRS 17 training series. Next, let's talk about IFRS 17 portfolios and groups. These are foundational concepts on how you divvy up your business under IFRS 17. And a portfolio is a collection of insurance contracts that are subject to similar risks and that are managed together. So what does it mean to be subject to similar risk? Well, contracts within a product line would have similar risks, and contracts within a different product line would most likely have different risks. What does it mean to be managed together? Well, this means that the contracts are managed by similar departments and similar functions within your organization, and it allows for the possibility of contracts in different product lines to be allocated into common portfolios. Next, we have IFRS 17 groups, and this is a further division of portfolios into groups of insurance contracts. There are 3 requirements for a group. The first is a profitability assessment. The second is the requirement to have annual cohorts. And the third, there are further considerations that may apply to your business. So let's talk about profitability first. There are 3 types of groups. The first is a onerous at initial recognition group, and where onerous means unprofitable, and initial recognition generally will mean when coverage starts for the group. So this means that it's an unprofitable group when the group was founded. The second is that you have no significant possibility of becoming onerous. This is rare, but represents very profitable contracts. Think contracts with a 10% loss ratio or less. And then all remaining contracts. And this would be where most insurance contracts would fall, because they're not going to be unprofitable at issue. And also, there is a chance that they could become unprofitable if losses occur. So most of the insurance contracts would fall into this grouping. Next, we have annual cohorts, and the requirement for each group is that each group should contain only contracts issued within 1 year or less of another. So you can't have contracts issued more than 12 months apart from each other in the same group. There is an exception to this on transition if applying the fair value on transition approach, and that would be for any policies at the transition date or prior to the transition date. You can group those policies into one group, and those policies in that group can be issued more than 1 year apart, but going forward, none of your groups can have contracts issued more than 1 year apart from each other. And finally, some further considerations. You may want to further refine your groups by geography, by product types. For example, you may want a term 10 or T10 versus a T20 group. Instead of wanting annual cohorts, you may want quarterly or monthly cohorts. And finally, this might be more applicable to larger insurers. Smaller insurers and mid-size insurers may not do this, although some mid-size insurers may also apply further considerations. Next, we'll introduce the 3 measurement models. The first is the General Measurement Approach, or GMA, and it's also often referred to as the General Measurement Model, or the GMM. In our course, we will refer to it as General Measurement Approach. Then you have the Premium Allocation Approach, or PAA, and finally the Variable Fee Approach, or VFA. So what is the GMA, or General Measurement Approach? Well, it's the approach used for most long-term contracts, and it's also known as the building block approach because it has 3 components or building blocks. The first is the best estimate liability, or BEL. The second is the risk adjustment, or RA. And the third is the contractual service margin, or CSM. And you can watch our video on the GMA approach to learn more about this. The second approach is the Premium Allocation Approach, and this is a simplified approach for short-term insurance contracts that are 12 months or less. And it may also be used for contracts where PAA would not differ materially from the GMA over the life of the product. So if you had a contract, for example, that was 24 months, you might still be able to use the PAA, but you have to show that the results under the PAA are not materially different than the results calculated under a GMA approach. So this approach is applicable to many group insurance coverages and property and casualty insurance coverages. And finally, we have the Variable Fee Approach, or VFA. And this is the approach used to measure insurance contracts with direct participation features. Here, the policyholder would participate in a share of a clearly identified pool of underlying items, and the entity expects to pay the policyholder a substantial share of the fair value returns on the underlying items. Also, the entity expects a substantial portion of any change in amounts to be paid to the policyholder to vary with the change in fair value of the underlying items. With the VFA, we have the same building blocks as the GMA, our BEL, our RA, and our CSM, but there are some special treatment or considerations of the CSM. This following table here shows the typical measurement models for Canadian products. So for group insurance coverage with periods of 1 year or less, the GMA could technically apply, but since it's eligible for the PAA, most carriers would likely apply the PAA here, and the VFA is not required. For group insurance with coverage period greater than 1, the GMA would apply, and the PAA might apply, but you again would have to show that the results calculated under the PAA are not materially different than the GMA, and the VFA would not be required here as well. For term and whole life products, the GMA would apply and would not likely be applicable to the PAA because most of those contracts will be longer than 1 year, and the results would differ materially between the PAA and GMA approach, and the VFA would not be required. For segregated funds, it's possible that you could apply the GMA, the PAA would not apply, and it's likely that you would apply the VFA. For universal life, there's a potential that you could use GMA or VFA, but not PAA. For participating life, you could possibly use the GMA, not eligible for the PAA, but you would likely be applying the VFA for par contracts. For individual critical illness, disability, income, and long-term care insurance, you'd likely apply the GMA, and it wouldn't be eligible for the VFA or PAA. And finally, for P&C products with coverage periods of 1 year or less, you could apply the GMA, but most carriers would apply the PAA because it's simpler and the VFA is not required. And finally, for P&C products with coverage periods greater than 1 year, think warranties, for example, the GMA would apply, but the PAA might. And what you have to do is analyze the results under your PAA and your GMA, and if the results are not materially different, then the PAA would apply, but if they are, then you have to default to the GMA approach. And here the VFA is again not applicable. The last two concepts we'll cover are the liability for remaining coverage and the liability for incurred claims. The LRC, or liability for remaining coverage, is defined as an entity's obligation to investigate and pay valid claims under existing insurance contracts for insured events that have not yet occurred, i.e. the obligation that relates to the unexpired portion of the coverage period. Under the GMA, which would be applicable to most life contracts and some P&C group contracts that are longer than 12 months, the LRC has three components, our building blocks: the best estimate liability, the risk adjustment, and the contractual service margin. Under the PAA, which would be applicable for most P&C contracts and group contracts, the LRC is just your unearned premium reserve. However, there is a difference in the definition of that premium. We're talking about premiums received and not premiums written. And there's a separate video on the premium allocation approach that dives deeper into this. The liability for incurred claims, or LIC, is defined as an entity's obligation to investigate and pay valid claims for insured events that have already occurred, including events that have occurred, but for which claims have not been reported, and other incurred insurance service expenses. And for life and group insurance, your LIC would typically include your claims payable, your incurred but not reported reserves, or IBNR reserves, and for disability business, it would include your disabled life reserves. For property and casualty insurance, it would include your case reserves, your IBNR, which consists of your IBNER and your IBNYR, where IBNER is incurred but not enough reported, and that would deal with case reserve development, and incurred but not yet reported, which are more like pure IBNR claims. So that concludes our basic concepts of IFRS 17 video. Thank you for watching.